I want to make an argument that's going to sound wrong for the first 2 minutes. Here it is. Some of the best run retirements involve deliberately paying taxes you were not required to pay that year. Not accidentally, not because someone made a mistake. On purpose. Writing a check to the government that you could have legally avoided. That sounds crazy. It's actually one of the most reliable ways a married couple can hold on to an extra $100,000 or more over a retirement. And once you see why, you won't be able to unsee it. Let's get into it. Start with what a tax bracket actually is, because I think most people have the wrong mental picture. A lot of folks imagine brackets as a ladder. You climb it, and if you climb too high, you get punished. All your income gets taxed at the higher rate. That's the fear, and it's wrong. Brackets don't work that way at all. The better picture is a set of buckets, lined up, filling one at a time. For a married couple filing jointly in 2026, the first bucket is your deductions, and nothing in it is taxed. Base standard deduction, $32,200. Add $1,650 per spouse once you're 65. Add the temporary senior deduction of $6,000 per person. Call it roughly $47,000 of income that costs you zero. Then the 10% bucket fills up. It holds $24,800 of taxable income. Then the 12% bucket. It's big. It runs from there all the way to $100,800 of taxable income. Then, and only then, does the 22% bucket start filling. The crucial thing, filling the 12% bucket to the very top does not affect a single dollar underneath it. Nothing gets retroactively taxed higher. Only the dollars that spill into the next bucket pay the next rate. That's it. Okay, so here's where the argument gets interesting. If you're a retired couple living on, let's say, $60,000 a year, and most of that is coming from savings and a brokerage account, your reportable income might be tiny. Maybe you're not filling the 10% bucket. Maybe you're not even filling the deduction bucket, which means there is enormous empty space in your 12% bucket. Space you're allowed to use. Space that expires on December 31st and does not roll over. And you have a big traditional retirement account sitting there full of money that has never been taxed, that will eventually have to come out. And that will very likely come out at 22% or higher when it does. So the question becomes obvious once it's framed properly. Would you rather move that money at 12 cents on the dollar on your schedule or at 22 cents on the dollar on the government schedule? That's the whole strategy. Fill the bucket on purpose. Let me put actual numbers on a couple. Call them Dale and Patty, both 68, both retired. They're spending about $65,000 a year. Social Security hasn't started. They're delaying to 70. They're living off a brokerage account, and their reportable income for the year is about $12,000 of dividends and interest. $12,000 against roughly $47,000 of deductions. They owe nothing. Zero federal income tax. Most people in that spot high-five each other and move on. But look at the empty space. They could recognize another $135,000 of income before they'd leave the 12% bracket. And their traditional accounts hold about $800,000. So they convert $130,000 to a Roth. Their tax bill goes from nothing to somewhere around $11,000, which feels awful. They wrote a check they didn't have to write, except that $11,000 just moved $130,000 permanently to the tax-free side at an effective rate of about 8.5% across the whole conversion. If that same money had come out at 75 as a required withdrawal, stacked on top of 2 Social Security checks, it would very plausibly have been taxed at 22%, and it would have dragged more of their Social Security into taxable income at the same time. Call it $29,000 instead of $11,000. Same money, same couple. $18,000 of difference from one decision in 1 year. Now, run that play 5 years in a row, and you see why this matters. If you're the kind of person who'd rather run the numbers than hope for the best, subscribe. That's genuinely the whole audience here. Now let's talk about the ways people get this wrong, because there are several and they're avoidable. Mistake 1, filling the wrong bucket. 12% is usually a bargain. 22% sometimes is and sometimes isn't. 32% almost never is. The strategy is not convert as much as possible. It's convert up to a specific line and then stop. Know your line before you start. Mistake 2, forgetting that income is stacked, not separate. If you have capital gains, Social Security, dividends, and a conversion all in the same year, they interact. A conversion can push capital gains from the 0% rate to 15%. It can pull more Social Security into taxable income. You have to look at the whole return, not one line of it. Mistake 3, paying the tax out of the account you're converting. If you convert $100,000 and pull the tax money out of that same retirement account, you've shrunk the thing you were trying to grow. Pay the tax from outside money from the brokerage account or cash, and the entire $100,000 keeps working. Mistake 4, ignoring the 2-year Medicare look-back. Medicare sets your premiums using your income from 2 years earlier. So a big conversion at 63 shows up in your Medicare bill at 65. If you're near a threshold, that's a real cost you have to price in. And mistake 5, doing it in December without checking anything. The people who do this well look at their income in October, estimate where they'll land, and convert a specific amount. The people who get burned pick a round number in late December and find out in April. Let me give you the actual mechanics, because fill the bracket is easy to say and a lot of people freeze at the doing. Sometime in October, put together an estimate of your income for the year. Interest, dividends, any pension, any withdrawals you've already taken, any gains you've realized. You don't need precision here. You need a number that's close. Subtract your deductions. That gives you your rough taxable income. Now subtract that from the top of whichever bracket you're targeting. Whatever's left is your room. Then call the company that holds your IRA and tell them you want to convert that specific dollar amount to a Roth. It's a phone call or a few clicks online. The money doesn't leave your control and it doesn't have to leave the market. You can convert the investments themselves. All that changes is which account they live in. Pay the tax from outside money and write down the date of the conversion, because there are holding rules on withdrawing converted amounts within 5 years. That's the entire procedure. Most couples imagine something far more complicated than what it actually is. Here's what I wish somebody had told me sooner. For your entire working life, the goal was simple: minimize this year's tax bill. Defer everything. Contribute pre-tax. Push it down the road. And that was mostly right, because you were in a high bracket and headed for a lower one. Retirement flips it. Now, the goal isn't the lowest tax bill this year. It's the lowest tax bill across all the years you have left, plus the years your spouse has after you, plus what your kids face when they inherit. And once that's the goal, a year where you paid nothing isn't a victory. It's often a year where you left cheap space on the table and pushed expensive dollars further into the future. So here's your takeaway. And it's a single number. Pull your last tax return. Find your taxable income. Subtract it from $100,800. Whatever's left is how much room you had in the 12% bracket last year. If that number is big and you didn't use it, you now know exactly what your next move is. If this was useful, subscribe. Every week I take one piece of retirement advice everybody repeats and check whether it actually holds up. A surprising amount of it doesn't. I'll see you next time.